Alrighty then, let's finish up this chapter on technical analysis by taking a quick look at Fibonacci. Fibonacci is a strategy or a rule that some technicians follow. So let's go over some of the details of Fibonacci. So Fibonacci was a renowned Italian mathematician from the Middle Ages. Look him up. All right. And his sequence is based on the notion that you can add two numbers to get a third number and create a sequence. So let's take a look at the sequence. Okay. The Fibonacci sequence, let me get my pointer here, 0, 0, 1, 1, 2, 3, 5, 8, 13, and so forth, and it goes on into infinity. Notice that each succeeding number is the sum of the previous two numbers. So 1 plus 2 is 3, 3 plus 2 is 5, 5 plus 3 is 8, 8 plus 5 is 13, and so forth, and so on. Scientists, I don't know how he came up with this, but scientists have found that Fibonacci numbers explain all sorts of proportions in nature. The width of trees, the growth of certain animals and insects. There's all sorts of proportions in nature that are explained by Fibonacci numbers. Technical analysts have found that Fibonacci numbers explain how far a stock price will move in one direction, either up or down, before it reverses and heads back in the other direction. So technicians have analyzed stock patterns and have found that the Fibonacci sequence applies to stock patterns. Very interesting. All right. The point of Fibonacci is to measure the likely magnitude of a price move away from a starting point. Once a stock price starts to move, how far will it go? Okay. For example, if a stock price begins moving up, how far up will it move over time before it corrects, comes back? And once it corrects, how low will it go if it does correct? Okay, so Fibonacci helps traders set buy and sell points. Where to buy a stock, where to sell a point, and where to sell a stock. And that is what all investors want to know, where to buy in terms of price and where to sell. So there are three key Fibonacci ratios. I'm not sure how we get from the Fibonacci sequence to the Fibonacci ratios, but it's really important to pay close attention to these three Fibonacci ratios. Basically 62%, 38%, and 24%. These are three key ratios. These ratios measure the percentage move of a stock price. Here's some examples. So first, the support price of a stock is 61.8% below the starting point. All right? If a stock, let's say a stock hits a peak of $100 and then begins to reverse, the first support level for the stock, according to Fibonacci, will be 61.8% of the starting price. So this is where the first support level would be, and so the technicians would recommend letting the stock go. Do not chase the stock, do not buy the stock until it comes down to 62% from where it started, which would be roughly 38%. Okay, a 38% decline. Okay, the next support level would be 38% of the starting price, which would be all the way down to $38, and the final support level would be roughly 24% from the starting point, 24% of the starting point, $24. So these would be the three support levels where they would recommend that you buy, buy, and buy. The same ratios hold for a stock that has troughed. It has hit a bottom, now it's coming back up. So let's say the stock bottoms at 50 and starts to turn back up. The next resistance level is 50 times 1.24, so roughly $62. The next resistance level above that is 50 times 1.382, which is $69, and the next resistance point would be 50 times 1.618, or $81. So You would sell, sell, and sell here, and buy, and buy here, according to Fibonacci. And I had a trader come in last year and speak to our class, and he was so fired up about Fibonacci because he found that Fibonacci really worked for him. When he paid attention to these ratios, he would know where to buy a stock and where to sell the stock. So let's look at some uses for technical analysis. Technical analysis is used primarily as a short-term trading tool. So these are not for investors, these are for speculators, people who want to quickly buy and sell. Okay? Technical analysis is used most often in volatile markets that are fueled by speculation, such as futures and options. So you find a lot of speculators, a lot of traders that have very short-term buy and sell holding periods, and they operate often in futures and options because there's a lot of leverage in futures and options. Also in currencies, also in so with commodities. So people who want to trade and want to try to make a quick, high rate of return, they'll use technical analysis. And the fact that these areas are populated by a lot of technical analysts or a lot of technicians, a lot of people who use technical analysis, it actually becomes self-fulfilling. If people follow the rules, then the stock prices will react in the way that people expect them to react. Not so much in broader, more liquid markets like the stock market. All right. Technical analysis is often used in conjunction with fundamental analysis. So a lot of brokerage firms and research firms employ technicians to work alongside with fundamental analysts. And if you can get a technical analyst and a fundamental analyst to agree it's time to buy or it's time to sell, then that's a pretty strong case to be made for buying or selling following the recommendations. All right, please note that there are many, many technical trading theories. There are several books out there. I've read a couple myself on technical trading theories. There are a lot of them out there, and what we did was we covered a few of the most commonly used approaches. So if you're interested in technical analysis, there are a lot of books out there that you can read that cover technical analysis. All right, so we are done with chapter 14, technical analysis, and we will move on to chapter 15. Shalom.